Hello friends, welcome to Bankers Plus Academy. Reserve Bank of India has recently issued revised guidelines for default loss guarantee or first loss default guarantee. The new framework comes with a new set of rules and stringent do's and don'ts for fintechs, banks, and will significantly impact all stakeholders including the end borrower. Here in this video, we are going to see the features of the new framework and the impact the new framework is going to make on the fintechs, banks, and also the borrowers. For that, let's first understand what's a FLDG or First Loss Default Guarantee. We know that fintech companies have entered into tie-up with various banks for lending purposes. The banks are called regulated entities and the fintech companies are called loan service providers or LSPs. But why they have come together? Fintech companies who want to deal in lending activities have to mandatorily depend on banks or NBFCs for their business. This is because fintech companies cannot extend loans to the public on their own. They don't have the license from RBI to lend. So they need to disburse the loans through some banks or NBFCs. For this purpose, these companies have entered into tie-up with what RBI refers to as regulated entities or REs. Regulated entities means commercial banks including small finance banks, primary or urban cooperative banks, state cooperative banks, central cooperative banks and non-banking financial companies including housing finance companies. In this fintechs banks partnership model, banks have the capital and license to lend, whereas fintechs have the technology and client reach. Here the fintech's primary role was to source the borrowers. But we know that banks will be very cautious while lending. They will do proper risk assessment and run background checks because if the borrowers default, they will be in trouble. But what if the fintechs offer their guarantee to compensate any loss that the bank may suffer due to the failure of loans brought by them? Surely, the banks will find such transactions safer and be interested in lending in such a scenario. So banks will sanction more loans and the fintechs will see their business growing if such an arrangement is in place. Therefore, when fintechs handed over customers to banks or NBFCs, some of them offered to guarantee defaults up to 20%. For example, if they sourced loans from the bank or NBFC worth rupees 10 crores, the fintech would take the hit for up to rupees 2 crores of defaults. That was the first loss that was guaranteed. The fintechs in a way was assuring the banks that they had done their due diligence and that they trusted their process and they were willing to provide the guarantee or FLDG. For the banks, it was sharing the risk with the fintech partner, which encouraged them to extend more and more loans. In fact, some fintechs were even ready to guarantee up to 100% default because fintechs wanted business, and obviously, if banks and NBFCs were guaranteed protection against losses, they would lend. But RBI was not amused. RBI was not convinced that the fintechs were indeed capable of taking such high risk. All these startups were not having the required risk management mechanism, debt to equity ratio, and sufficient capital to absorb any possible loss. Therefore, in August 2022, RBI imposed complete restriction on FLDGs and asked banks to stop the practice of accepting FLDGs from fintechs. But now, after less than a year, RBI has revived the FLDG model with a new framework, but with stricter restrictions on how banks and fintechs can partner. As per the new rules, a fintech can only guarantee losses up to 5% of the loan size, not 20% or 100% as before. So if a bank or NBFC doles out rupees 10 crores to customers sourced from these fintechs, the fintechs can now guarantee up to rupees 50 lakhs of losses on these loans. Secondly, fintechs have to give hard guarantees to the banks. The exposure will have to be secured by the fintech through a cash deposit. That is, a fixed deposit maintained with a scheduled commercial bank with a lien or a bank guarantee marked in favor of the regulated entity or bank. So these are the features of the new framework on FLDG issued by Reserve Bank of India. Thank you.